Welcome to the Victor H Investing live stream. It was a shortened investing week this past week. In the US, we celebrated the 4th of July holiday. Hopefully, everybody had a nice holiday, nice, safe one. You had fun with your family, fun watching fireworks and so forth. It was good to have a day off, and it kind of turned into a 4-day weekend. So hopefully, everybody enjoyed their weekend as well. With regards to investing, the market continued to go up, and that's good news overall. And as you heard me comment in prior live streams, it's also, at what point will the market begin to calm down? The S&P over the last 5 days went up 1.18% over the last 5 trading days, which is impressive considering that year to date, we're up 17.38%. A big part of the market running up this year is due to the big major caps. NVIDIA, Meta had a very good week last week. It had a very good day on Friday. It was up more than 5%. So was Alphabet. It was up big last week, which was really interesting. But overall, we're looking at a market. If you go back to its low point in 2022, it's up 55.26%, which is great. If you're seeing your stocks in your portfolio go up 55%, give or take, depending on how you're invested in which sectors, hey, I'll take it. I'll take all those gains. But I also want to be smart about it and have enough cash around. So if we do have a pullback like the one we had in 2023 of a little more than 10% on the S&P, I'm ready with some cash to invest in stocks that I really want to own. So the market's doing well. The NASDAQ's doing even better. NASDAQ tends to have more of those tech stocks, and it's having a phenomenal year, up 24.29%. And if we look at the low point in 2022 to now, it's up 77.8%. Man, tech stocks have really done well over the last 2 years for sure. So what's going to happen going forward? Well, my best guess, and it is a educated guess, is that we're going to see a pullback at some point. Not sure when it's going to happen, but it just can't keep going up like this. I would like for it to do that, but it just doesn't do that. Look at this. As we look at in the 1999, 2000 period, we had a correction, and then we had moderate appreciation. Then we had the subprime mortgage meltdown. Then we had very good appreciation. But once we got to COVID, it just got really extreme. 123.7% over the last 4 years. That's phenomenal appreciation. But at what point will it just be too high and we're going to see a major correction? I'm not sure. I'm just tracking it, looking at it, and feeling like stocks are expensive. So some sectors are really expensive, like semiconductor is really expensive. Some industries are kind of being left behind. A couple that have been surprises, one of them is energy. As we look at energy is really dependent on oil prices. And if we look at where oil prices have been and are going, oil is at $83 per barrel. That's very good for the oil company. Oil companies make a lot of money above $65 a barrel. That tends to be like the break-even point, so to speak. And they've been operating well above 65. So oil companies should do quite well. But if you look at the oil stocks, the energy stocks, they haven't been flying up like these technology stocks. So might there be some opportunity there? Maybe. I continue to buy Chevron stock. The other sector is healthcare. Healthcare companies have not kept up with the S&P overall. So that might be an area of some good upside. Hey, Quags, very good to see you on the live stream. Thanks for tuning in. Appreciate it. Let me know what you want to talk about today, man. And hopefully you're having a nice weekend. So there's some sectors that I think have been left behind, and some sectors just continue to perform. When we look at like Meta, year to date, Meta's up 53.68%. Had a very good day on Friday. Not too long ago, they had their earnings, and the street didn't like some of the things it heard. But, Meta, there's only one Meta in the world. And the market just said, hey, I'm going to buy that Meta stock. And it is now higher than it was at the peak right before their earnings. One thing I would mention about Meta that was interesting, and Quags, I'm going to get to your comment one second. And I use Meta platforms, right? I use Facebook, I use WhatsApp, I use Instagram, and I've been offered the Meta AI application, and I've used it, and it's really good. I don't see a big difference between that, ChatGPT, or Google's Gemini. The big difference is Meta's got billions with a B, billions of active monthly users. So it's going to be really interesting to see how Meta grows their AI users. When you saw X, which was Twitter previously, Elon Musk took over, started making some big changes, really made a lot of people upset with X and Elon Musk. And Meta came in and said, hey, we'll offer Threads. And Threads got to 125 million users, which is really good. And that's showing how they could quickly gobble up users in a particular platform. Well, AI may end up being similar, like a platform where you go and you get, really AI assistance. You can do research, you can ask questions, all that good stuff. Well, Meta's got billions of users, active users, and they're offering up at no fee their AI application. I think that has a lot of potential. And I bet you that maybe not this next earnings, which is less than a month away, but I would guess that Q3 earnings, they're going to start publishing the user counts they have for AI. And I think that's going to send this stock flying, because I think if the market sees that, Meta just got, 50 million users of their AI platform, look out, it's just going to scream up. There's a difference between ChatGPT and Meta. And also, I'll just stick to that one. ChatGPT is a standalone company. It was actually a nonprofit, but now they're become a for-profit entity, and they're in partnership with Microsoft. At what point is Microsoft just going to acquire them? Because ChatGPT is kind of going to market with, hey, come to our site, use our app, and trying to grow their user base kind of organically, which by many accounts, it's working. But it may be a case where Google and Meta take away the user base, because Google's got billions of people using Google search, YouTube, which we're on right now. And they could really take a lot of the users, because it'd be easier just to go to one place for search, YouTube, even, programming like YouTube TV, or Meta, which is, hey, I check, Facebook every day. I could also get my AI platform there as well. We'll see how that evolves, but it was really interesting to see that. I don't think it had a lot to do with that 5% pop we saw on Friday. But I'm really happy with my investment in Meta, and very optimistic in that company. So let me catch up on some comments. let's take a look at EQNR. I'd like to do that. It's an oil company, and it's an oil company in Norway. I never knew Norway had that much oil, but they do. And we're going to take a look at it. It's a company I've evaluated in the past. We'll take a look at it. Thanks, Quags, for the suggestion. And looks like we've got best of. Thanks for tuning in, man. Hopefully you're having a good day. Mike, good to see you again. I know you hold MPW, as do I, but have heard anything why you jumped a little on Friday afternoon. Any thoughts? Okay, so I do have some thoughts on MPW. I looked at it yesterday, and I'll go through that thought process I had, and then you've got some other symbols out there. CCOI. I'm not sure I know that company. MCD. ALB. And then PAYC. All right. We'll take a look at those. Please suggest any other symbols you want to look at or any topic you want me to comment on. I'd be happy to do that. I'm an individual investor. As always, everything that I talk about related to stocks is just my opinion. It's really for educational and entertainment purposes. I don't recommend you buy, hold, sell any of the shares that I'm going to talk about. I'm going to share what I'm doing, and hopefully you find it interesting. It just gives you a little more data for you to make good investing decisions. I hope you all make lots of money. Also, if you're interested in earning 8.1% on your cash, take a look at the offer from my sponsor, Moomoo. The details are in the description of the live stream. You can take a look at that, and if it's the right thing for you, you can set up an account. If you deposit more than $1,000, they'll give you 15 free stocks. So, all right, so let's get into EQNR. And EQNR is an oil company down in Norway, and they found a lot of oil. It's predominantly its end market is Europe. No big surprise. And it really is an interesting company. It pays a whopping dividend of 14%. Cha-ching. That is nice. If we look at the year, right, I showed you where oil prices have been. This is my point on oil companies is, okay, they're getting more per barrel. Why is the stock price pretty much lower than at the beginning of the year? That's where, to me, it begins to tell me, hey, there might be opportunity here to buy into this oil company. I'm going to talk about EQNR, but I'm also going to talk about Chevron, which is the stock that I own. And I try not to own too many of the same. I'm going to cover this because that was a question asked, and then I'll compare it to Chevron, which is a stock that I own quite a bit of shares on. So this company here pays a whopping dividend. I'm going to guess that they can pay that dividend. And the reason for it is if we look at their financials, we look at their free cash flow, they have awesome free cash flow. Okay. So they produced $14.1 billion. And is this in dollars? Yeah, it's in dollars in 2023. They're not giving me quarterly data. Sometimes European companies only report twice a year. So it doesn't give you quarterly sometimes. So we'll just go with the $14 billion, which is phenomenal. And we look at their growth rate. If we look at their income, you can see where oil prices are really affecting their income. And we saw a drop in oil in 2023 to some extent, but we're seeing a rise in oil price. And it's easy math. If you get more for a barrel of oil, you're going to get more revenue. So overall, I'm not an investor in Equinor. I'm not interested in buying shares of Equinor because I'm a Chevron investor. This is my third biggest holding, over $100,000 invested in Chevron. And they pay a nice dividend. This company is headquartered in Northern California. It's very well operated. The legendary investor Warren Buffett is an investor in Chevron, long-term holder of Chevron. So just to give it some credibility. This one has underperformed Exxon, and I mean it's incredible to see Equinor paying this dividend. It's like, holy smokes, man, they are printing money over there. And so Chevron doesn't pay quite that much in the dividend. They are a major, big, massive cap company. What was the market cap of $80 billion over from Equinor, which is interesting. Wow, man. This seems like an undervalued stock. Just it's showing me some variables there. What's the balance sheet look like? Balance sheet, we've got $38.8 billion of cash. Total debt, we have 31. So they have more cash than they do debt. Man, I'm liking what I'm seeing in Equinor. Really good stuff. And just going through some of my process, right? If you guys watch the video where I cover moats, moats are really important. An oil company has a very strong, wide moat. Why is that? Because there's only one planet. And at this point, much of the planet has been explored for oil or natural resources. And companies like Equinor, which have oil fields in Norway, they control that area. It's a big barrier of entry. Somebody can't come in and start drilling for oil in the areas that they control. Same thing with Chevron, Exxon, other oil companies. So I put them in the green, high desirable quadrant for that reason. They are dependent on oil prices. But as countries really move to a society that everybody has a car and they start consuming more energy, that just puts more demand on oil. So overall, I really like the industry. I like a lot of things I'm seeing in Equinor. Good luck. I think it was Quags that asked. I'm positive on Equinor. I'm not a buyer because I own Chevron. So hopefully you can respect that. Thanks for the question. And I think you had one last comment on Equinor is the government owns 60% of the company. Is that a good thing? Overall, I don't like governments owning companies. And the reason for it is when you have governments owning companies, you have politicians that are driven by, their society. And there's nothing wrong with it, right? If the voters in the U.S. said, hey, we're going to vote a leader, a politician that should tax oil, I'm not saying this is going to happen, tax oil 100%, and it just really screws up an industry and a company. It's because that large group of people, right, that society, that population made a decision and it really impacts that company. Things like that could happen. Like down in Venezuela, and I know I'm going deep on oil. I worked at an oil company, first job out of college, and it was a great experience. Down in Venezuela, they have a lot of oil. The government controls much of that oil. Well, that government, has really made that screwed up. You look at the Venezuelan oil industry, it's really upside down and screwed up. So my answer to the question is I don't like when government owns a big part of a company. I have nothing against Norway. I have very little knowledge in Norway. I imagine that they don't want to screw up a good thing, but we'll see. All right, so let's keep going. Appreciate you, Quags. Shadow Guy, very good to see you, man. All right, cool. So you're looking at L. And hopefully I find that. What's the L.herd? Okay, let me take a look at that. All right, so let's talk about MPW. So MPW is a real estate investment trust. They own predominantly like hospitals and healthcare facilities, like urgent cares and so forth. And what's been interesting about the company is, it's not a big surprise. It's been really going down in price, down 77% over the last 5 years, down 55% over the last 12 months. Now, the one thing to keep in mind is, this stock, depending on when you buy, you could really do well. if you bought, let's say, shortly after the new year, you'd be up 36%. At the high point, you were up a lot, like 90%. So this stock, if it continues to repair its business, it's going to reward investors, because historically it trades up in the low $20 per share range. They own a lot of assets that are really worth owning. Hospitals aren't going anywhere. A lot of the places where we go get our health care are not going anywhere. Now, their primary tenant, their biggest tenant, got into financial trouble. They're in bankruptcy. And that's what's really holding back the company. If that steward can repair their business and become a better tenant, and MPW can continue to repair their business, this stock's really going to go places. They pay a very large dividend compared to their share price. Recently, it's really down. And it's really, the thing about bad news is it gets recirculated. Like the bad news that they're dealing with, they've been dealing with it for like the last year and a half. So it's not new. So that's good. But you just got to get through it. Once they get through it and they get to the other side, that bad news, I think this stock's really going to go up. I went through a hard, I tend to look at my portfolio, and I'll show that just briefly. And what I try to do is, should I be inside of a particular stock? And when it comes to real estate, I own CTRE, Care Trust, and I own MPW. And I really, challenge myself. I started with the proposition of I should sell MPW. I should sell it. Just get it off my, portfolio. I don't want it to be a distraction. And I'm kind of feel like a little bit like I'm waiting around for this turnaround, which could happen. It may not happen. But when I looked at the fundamentals and what's going on, I just couldn't sell the stock. I'm like, no, this thing, I think the chances are they're going to repair their business and it's going to go up, versus they're going to crumble and go bankrupt. And part of it is that they're a real estate investment trust. So they have real good assets. Like if they sell like a hospital site, they get capital, they get money. Okay. So it's not like they're sitting on inventory that nobody's going to want, or maybe some R&D that never made it to a final product and they have to scrap the whole thing that's worthless. No, these are properties that are worth money. So they can sell some properties to get out of their financial trouble. So that's what kept me in the stock. I think if we move forward, if we could see the company heal a bit and we see these lower interest rates finally come, which they should be coming at some point because the economy isn't doing great in the U.S. So the U.S. Federal Reserve should start lowering interest rates. I think that's going to help MPW. So I'm going to be holding MPW. I do really track that company monthly, and we'll be a buyer. And it looks like Mike had a comment on MPW. Let's take a look at that. I sold my MPW, but then after the drop, I bought again. And I've been dollar cost averaging since. I'm probably too exposed in MPW, but I really like the dividend. It appears it's slowly improving. Yeah. Thanks for sharing your strategy there. I think it's probably going to reward investors if one stays in it. Not a guarantee, right? They're still in financial trouble, but again, it's a type of business where they have hard assets, man. You sell a couple of these properties and you generate a lot of cash. So we'll see what happens. All right. So I'm going to jump to, I think I handled a question or a stock symbol for Quags, one for Mike. Let's jump over to the one that Shadow Guy had, and then we'll go back to the list I think that Quags provided. So we're going to look at Loews Corporation. It's a conglomerate. Okay. So let me try to look for that. There it is. Okay. Loews Corporation. And let me get familiar with this business. So Loews Corporation, commercial property and casualty insurance in the United States and internationally. The company offers specialty insurance products such as management, professional liability, and other coverage products, surety, fidelity bonds, property insurance. Okay. Insurance has been working. Okay. I own Allstate. I was also owning Prudential. They really worked, really good returns. So what's been happening with these guys? Year to date, up 5.9%, which isn't great. But for the year, pretty decent, 24.49%. So insurance is one of those industries, if we look at kind of like the quadrants that I've been kind of speaking to, I put insurance kind of in the gray area. You could say that they have a moderate barrier of entry, and depending on the company, they may have a strong or medium or weak strength moat. Why are insurance companies in this category? Well, you can't, like, a business can't, start and say, hey, I'm just going to insure people, or corporations and companies in this case here. They actually have to raise capital. They have to have credibility in the market, because customers are not going to sign up with an insurance company that is brand new, that nobody knows about, because the fear would be, I buy a policy, and then if, something bad happens, I have to go make a claim against that policy. Are they going to be around? Right. So that type of credibility is important. These guys have been around for how long? So headquartered in the United States. Not sure. I think I've heard of them. I'm just not that familiar with them. And I don't know when they were founded. So, okay. So their market cap is fairly low, 16 billion. That's pretty low. They are profitable. Look at their financials next. PE ratio is nice and low at 11. That's really good. They didn't provide a forward PE, which is interesting. Really low dividend. That's a little bit of a surprise. Maybe they're in growth mode. When we look at their revenues, they had really good revenue in 2023. They continue that growth in the quarterly. So that's looking good. And it's kind of a lower number. So a company like this can sustain this growth rate because they're not massive. They're not like Walmart with $500 billion of revenue, as an example. So that looks good. They are profitable. Very good. When we look at their balance sheet, they have $399 of cash, total debt of $9 billion. Okay. What's their debt to EBITDA? Debt to EBITDA is 3.46. That is a little bit high. I like to see it below 3. That would be a concern. That's a risk factor. Okay. So looking at their free cash flow has been growing. And, this is like a confidence builder when you see a company grow, year after year. That is a confidence builder for me. It goes to show that, hey, they're doing something right. They kind of hit a wall in 2018. Not sure why. But last 5 years looks really good. So cash flow looks good. Looking at their cash flow and the fact that they're growing, my back of the napkin kind of analysis is this company's worth more like 50 billion. If I were to do analysis on this company full blown, it would be worth about 50 billion. Let's go ahead and do that. We'll do a quick analysis based on free cash flows and earnings per share on this one. And so I'm going to compare this one to Allstate. So Loews, I'm going to use a discount rate of a little higher than Allstate because it's lesser known. So I'm going to say, hey, 10%. It's higher risk. So, all right. So we saw that free cash flow. And try to get both of these up. I try to squeeze both of these items on the same screen. Okay, so we looked at their free cash flow, and free cash flow was $3.2 billion. Okay, so we'll use that. Okay, 3.22. So the growth rate was really good on that. So I'm going to go with like 8% in the first 4 years and then let it grow at 4% after that. So just the intrinsic value of those cash flows is $55 billion. So that's looking good. I think the free cash or cash on the balance sheet was like 399, and then debt was 9 billion. So once I take away that debt, we're at 46. The market cap of the company is 16.3. And shares outstanding are 221 million shares. So really the value per share based on free cash flows that I'm getting to is $209 per share. It's heavily discounted if you look at their cash flows. Let's take a look at their earnings per share. So here's their financials. Why am I not seeing earnings per share here? Statistic, dividends. So usually I see the earnings per share, but for some reason I'm not seeing it. So earnings per share is $6.73 for the trailing 12 months. Let's use that just to get in the ballpark. 673. This is a growing business, but we'll be conservative and go with 12. It has been growing, so we'll leave it at 10. So even if we look at earnings per share, it's discounted by 20%. So overall, Loews looks really interesting. I don't know a lot about the business. I would investigate, is it a good business? You know, are they maybe in a category of insurance that's really growing, which would be interesting. And then if it's a business that you want to be a part owner in, the fundamentals show that this company is way undervalued. It looks really good. So hopefully you found that interesting, and I'll move on to the next one. I wouldn't be an interested party in Loews because I'm happy with Allstate. I just consolidated my position in insurance. I used to have Prudential, and I sold Prudential and just started buying more of Allstate. Allstate's going to be my insurance type company, and that'll be part of my portfolio. But Loews looks really good. You know, good luck with that. Hopefully you find that interesting. All right, let me catch up on some stuff here. Okay. So Chi Wong, nice to see you again. Second time info, really appreciate it. Gonna do some research on a few stocks you mentioned. Yeah, thank you for tuning in. I appreciate the comment. And then Shadow Guy. Yeah, they have several I would look into that, you know, Loews as an insurance play. They are their fundamentals look pretty damn strong. You know, very, very good fundamentals. Okay, so Vikram, good to see you. I don't know if you've been on this channel. I think you asked this on one of the comments on one of the videos. Waiting for 5.9 analysis. Yeah, let's take a look. So it's 5.9. So 5.9 and its subsidiaries do intelligent cloud software for contact centers. It offers virtual contact center. Okay. So it does, I'm going to call it CRM software for contact centers. Okay. All right. And I'm going to go to their website just to 5.9. Okay. Got it. 5.9. So I looked at this stock when you put the comment down, and I wanted to make sure I understood it because I wasn't sure if this was the company that built their applications on the Salesforce platform. So systems integrators, okay, cool. Okay, so this is a software company. Okay, so this is a software company. $3 billion valuation. Wow, they're down a lot overall. So 19%. Well, the chart kind of doesn't look right. Yeah, down 46% over the last year. Year to date, 45%. So why are they down so much? So earnings per share, they lost some money. Forward PE. So real quick, just to go, where do I put software companies? You know, many software companies belong in the highly desirable quadrant, where I look at software companies. Microsoft's a software company, very profitable, makes a lot of money. Another company that I'll put out there is Adobe. I like Adobe, and I put them in this category. So software companies can be very valuable, just depending on what is their micro industry. The CRM space is crowded. And FYI, I've worked in the software business, so it is an area that I do have some experience in. It is a crowded space. When we look at their revenue, we're going to look at the quarterly. They are growing. So why is your stock price falling? If you're growing, your stock price should be going the other way. Now, it's kind of, you can forgive a company for not being profitable if they're growing, which these guys are. So what gives? Why are they seeing their stock price go down? Cash is $730 million. When we look at total debt, they could pay off their debt right away. So, okay, debt's not a problem. Cash, they're generating free cash. It hasn't been super consistent, but they're generating free cash. Okay, so let's say based on their free cash, it wouldn't have a valuation very much above $3 billion. I would say that. And this is what I was looking for Loews that I couldn't find a minute ago. Okay, so the forecast here, 14 analysts cover this company. They say it's highly discounted, 92%. Wow, that's pretty good. It's a strong buy by analysts. And they're saying that it's going to have a $2.23 profitability, and it's going to grow those profits. So I'm seeing, and I'm not like super informed on what they do. Like they have, call centers. I think what might be happening is, right, call centers are where you have a question on a product. Let me give you a good example is like we talked about Allstate, right? And you call in, you go, hey, I'm an Allstate policyholder. I have a question. You're calling a call center and they pick up the phone, they talk to you, or they might even chat with you. So those call centers are supposed to be disrupted by AI. So that this might be that AI is expected to really lower the number of people you'll need in a call center. And it's going to change the way we get service. And it does make sense. That would be a use case for AI that I agree with, which is you can call and talk to somebody who's going to basically type into their keyboard and type questions like, oh, Victor is calling and he has a question on his policy. Why can't you just have an AI application and give you a digital experience to answer those questions? That's totally doable. That's doable right now, right? And I think that's just going to continue to get better and better and better with AI. So I think that's what we're dealing with is you're seeing that a big disruption in call centers is approaching because AI is going to change that completely from it being you put people in a call center and they answer questions on the phone or maybe by chat, and you put it completely into a application, an AI application, then you don't need people. Then you don't need to buy software from Five9. You don't have to license, 1,000 employees. You could just say, hey, we don't need that software anymore. We bought the ChatGPT software or the Google Gemini software or solution or platform, whatever they want to call it. And now 90% of the questions that are coming into this company are being answered. That might be why investors are, not investing in Five9. Five9 may have an awesome solution. The fundamentals look really strong, but I would say, I think that's why this company is being unappreciated is you have this big story, which is AI. Can't argue with it. It's really the biggest story we've had in the last 2 years in investing. And I think that's the big threat against Five9. So Vikram, thanks for showing up to the live stream and asking your question. I hope you found my comments interesting. And I appreciate you asking. It's an interesting company. You're finding a company with very good fundamentals. So thanks for bringing it up. Blake J, I've noticed some companies or industries prefer to have higher debt to equity ratio. Yep. And I guess access to capital. Yeah. When you look at real estate investment trusts, there's no way around it. They buy these big properties and they have to carry more debt. So I don't use that debt. The debt is kind of a big liability for a real estate investment trust. And also when you look at banks or financial institutions, debt's a different animal there. It's almost like it's an ingredient to their overall product, which is financing for other companies. So you're absolutely right. Some industries, debt is a different animal. For most industries, debt is very bad. It's negative. If debt gets too high, it disrupts your business. Companies become slaves to debt. They have to service the debt, meaning they have to make payments. Then they just operate to pay debt. And that's very bad because it disrupts their growth plans. It makes them undesirable. That's why I look at the balance sheet. When I look at a balance sheet, I want the debt to EBITDA to be less than 3 in most cases. I don't use that ratio. If you look at my videos on real estate investment trust or on banks, like I own Citibank. And if you looked at the debt level they have, it'd be like, wow, that's way above, 3 times EBITDA. Yeah, it is because it's a bank. They want to take on debt. They want to borrow at 3%, 5% and lend at 10% to make a simple example. They want to put car loans out there. They want to put mortgages out there, and they want to have a spread on that debt. So very good observation. I appreciate the question. All right. One of the regulars, Android PC gameplay. Hello there. Good to see you, man. Quags. I think I've asked before on UPS. I have covered UPS a few times, and it's a quality company. I've tried to follow UPS. Part of it is like a long time ago. I worked one Christmas season at UPS when I was a young man in college. And man, I had so much respect for that company because every day that I showed up, I worked really hard. I didn't have to go to the gym because I was unloading these trucks with packages for the holiday season. And I saw how efficient the company ran. I saw the attitude of the employees. They were happy to be there. It was just like a really good culture. It was a great experience. They offered me a permanent job, but I had school. So I just went, I told them I couldn't take the job because I had my college education. But I always had a high respect for UPS. They are a company that really benefited from COVID. And you can see that in the 5-year chart, right? Hey, COVID hits. Everybody has to get everything delivered to their home. Well, their stock just took off. It doubled very quickly. And now we're dealing with, okay, now that COVID's over, where are you going to grow? So when we look at their growth rate, they're not growing. So what's going to cause growth for UPS? That's the question on the business. And Amazon's not doing them a favor because Amazon is doing their own deliveries. They have their own like logistics network now. They also compete against FedEx, the US Postal Service. So that'll be interesting to see how that sorts itself out. I think if the company starts to grow, let's look at their quarterly. I think that'll be important, and that'll make the stock rally. From a valuation perspective, I think when I looked at it last, it was kind of either fairly priced or, plus or minus 10, 20%. When we look at their free cash flow, $5 billion, but it's been better in past years. And mainly because, during the COVID years, they were just booming, right? People would pay whatever they needed to pay to get stuff delivered. But now they're kind of competing in a market that's more, if anything, they're dealing with maybe people bought everything they needed during the COVID years. And they're like, I don't need to buy, 5 TVs. The 2 or 3 that I already own are fine. I don't need another delivery. And that kind of thing is going on. So how are they going to grow? That's going to be the question. At a $5 billion per year in cash flow, I'm not going to get to this valuation. It's going to be highly overpriced, maybe by 30%. When we look at the forecast, 21 analysts cover the company. Okay. They're saying it's discounted. All right. Well, maybe. And we look at their earnings per share. It's expected for 2024. It's expected to grow and continue to grow. But you can see that their revenue in 21 and 22 it hit 100 billion, and they're not going to hit 100 billion again until 2026. So this is the valley of, the company stopped growing. Are they going to be able to get back to growth? If they don't get back to growth, this is going to be a value trap. I think it's going to catch a lot of investors, and it's just going to be dead money for a while. I hope that's not the case. I like the company, but I can't let my emotions drive my capital because then I lose money. So that's my opinion on UPS, Quags. And good luck with that. Love to hear your comments on it and what you think. Mike B, you like L. Yeah, I liked what I was seeing there, man. I like insurance companies, man. They had a rough 2022, 2023, but then they really came back. And the thing about insurance is you may see an insurance company have a bad year, maybe a couple of bad years, but then they reprice their insurance products and they say, hey, and I think part of it was inflation made assets more expensive. So when a car was in a collision and it was totaled, to replace that car was more money, or to repair that car was more money because inflation made cars more expensive, or the parts. Well, insurance companies, they don't reprice every day. They reprice every year. Now their pricing is caught up with where the market's at. And insurance companies, in my opinion, have looked good for about a year and continue to look better. They get to take their money and invest it. When people buy insurance policies and they say, yeah, I'm going to give you $2,000 for this insurance policy, the insurance company gets to take that money and invest it and make money on that cash they're holding. Warren Buffett is a big investor in insurance products. They own all of Geico. He liked them so much, he bought the whole company. And so it goes to show that, hey, and he had a recent investment in Chubb that caught a lot of press. So he loves insurance companies for that reason, that, hey, they're resetting their pricing. They get to hold a lot of capital and invest it. Overall, I like insurance companies. I've just really focused my capital right now on Allstate. That's going to be the horse I'm going to ride. Totomi, hi, man. Is this your first time on? I like have your opinion on a TMF. TMF. Never heard of it. Let me take a look at that. Give me a second to catch up on some comments. Shadow Guy. By the way, you know, ETF TQQQQ, 3 times leverage ETF on the NASDAQ. You know, I'm not a big ETF guy, but let's take a look at that. All right. Yeah, I'll take a look at that. And then here's Talmiz 100. You like Bitcoin here? You know, man, I've noticed. Let me take a look at that, and I'll have some opinions. Now, this is mainly a stock investing channel, and I'm mainly a stock guy, and I'm a real estate guy. I've invested in real estate and stocks for a long time, and I started investing in cryptocurrencies, and I'll share with you my comments on Bitcoin in a few minutes. Let me just catch up on comments. So Brian Wall, hey Victor, hey, thank you for that comment. I appreciate that very much. I hope you guys are liking the videos. I'm putting more effort into my videos where I want to make them more interesting, what I consider is more valuable, but you're seeing fewer videos. And what I'm trying to do is put maybe 2 or 4 times more time and thinking and saying, hey, what would be interesting and useful to the investors that tune in to my channel? That's what I'm trying to do. And I really appreciate a comment like the one I just read. What do I think of WHR? Oh man, I just looked at that yesterday, you know, on my own. I do have some comments there, so I will show those with you. Hang tight. Let me just get back to the list here. We're going to look at TMF. So this is Direction Daily 20 Treasury Bull, 3 times shares. So the 20. Okay. So this is a ETF that focuses on long-term bonds. Very good question. Let me jump into this one. So first, what the heck do I like bonds? Well, here's all the bonds that I own. And the longest tenured bond that I have out there is probably like 20 years, but just a tiny bit of money, okay? The one I would highlight that I love, my favorite long-term bond is where the heck is it? Here it is. So this one here, and I know it's an eye chart, but this is the Petróleos Mexicanos note. This is a bond for the Mexican oil company, and it produces basically 11% return for me out of a bond, and it produces really good cash. So long-term bonds, if you buy them at the right time, are a really interesting investment. If you buy them at the wrong time, it could be a really big loser. And the Silicon Valley Bank meltdown of 2023 was driven by their overinvestment in long-term bonds. As an example, they took big losses. Now, what's going to happen with 20-year rates? Now, rates are dropping, and long-term rates, I'm not an economist of this type. I don't know what they're going to do over the next 20 years. But over the next 5 years, I would expect interest rates are going to go down. So this wouldn't be a bad idea. This one here, it's not giving me the right data, but no, it actually is. So it has a dividend yield of 3.5%. That's pretty good. If we look at the 5-year return, right, this is where rates began to go up, okay? When interest rates go up, bond values go down. Adverse relationship. Interest rates go up, bonds go down, okay? And that's what you saw here. Now, just high level, now we're expecting interest rates to go down, bond values should be going up. So for the next 5 years, this isn't a bad idea. But I would make sure that you understand what you're buying. Bonds are, why I buy bonds is to diversify away from stocks. And I try to buy bonds that I understand, and I'm not going to take any losses. I just want a steady upward appreciation curve or yield curve. And I don't want, big risk. This one's out of my zone. I don't want over leverage on the long year bond rate. Somebody that understands it may make a lot of money there, but it's not for me. And those are my comments on that one there. Thanks for the question. So that was TMF, correct? Okay, cool. Next one is TQQQ. And this one is, so you're looking at the NASDAQ and 3x leverage. So I'm going to give you, my comment is right now, the NASDAQ is set for a correction. So if you're going to be 3x the NASDAQ right now, it would not be something I would be interested in doing. Because I think if we have any type of correction, you're going to see that times 3. How much higher can the NASDAQ go, right? Well, right now we're sitting on a NASDAQ that is really expensive. This is the history going back, to 1984. Over the last 5 years, we've seen the NASDAQ really climb. So how much more climbing is it going to make, right? Or do? And I would say that I'd have to be on the side of the boat that thinks the NASDAQ is going to have a correction, sometime soon. And is it going to be continued, upward and to the right? I would say no, I don't expect it. I think at some point you're going to see some of this, like here was a big correction due to COVID. Not too long ago in 2022, the NASDAQ dropped 35%. I mean, that's normal. That's good. That's healthy. That means that the stock market got too high on the NASDAQ. It needs to come down on prices. It usually goes down further than it needs to, but that's just the market. So my comment on TQQQ is that I don't like that proposition right now. I think there's too much risk to the downside, and I wouldn't be a buyer. All right, let's talk about BTC. And BTC is Bitcoin. I invest in Bitcoin as a hedge against the stock market. If you look at the return on Bitcoin, it rivals my best stocks. So I know that it's one of those things where you either need to believe in, understand, and believe in cryptocurrencies, which I do. Are they going to completely revolutionize the way we do business? No. Does it have certain use cases? Yes, it has very good use cases. Bitcoin is a store of value, similar to gold. And I never understood gold to begin with. I never understood why somebody thought an ounce of gold was worth however much it's worth, right? But Bitcoin, I understand more than gold. Bitcoin is a store of value. You can easily transferable. It has demand. I think the market cap is in the trillions now for Bitcoin. So all those things really line up well. But it starts with really understanding cryptocurrencies, and don't ever invest in something you don't understand. If you don't understand it, learn more, pump the brakes, really think about it. For me, I've been a small investor in Bitcoin, a small investor in Ethereum, also participate in a very small liquidity pool. And so far it's been good, especially if you look at from the depth of 2022 to the height, it was a 309% return. And even with the most recent pullback, it's still really good investment. The recent pullback, I think, was driven because there's a big crypto exchange that had gone bankrupt. Now they're paying back all the people that had money at Mount Gox. Probably pronouncing that wrong. And they're going to buy something like $9 billion or some big number of Bitcoin. Sell. And when you put that type of volume in the market, it has a negative effect on the price. I think over time, it'll continue to climb. I'm not buying Bitcoin right now. I'm interested mostly I'm expecting that the market's going to correct, and I'm putting a lot of time and holding my capital. I'm actually starting some short positions on companies. I have an NVIDIA short position. I have a couple other short positions, and This week, I'm probably going to start a short position on an electricity company. I think utility companies are terrible investments. I always thought that. And most recently, their stocks have really run up because the AI hype is saying, oh, we're going to need all kinds of power. Yeah, we're going to need more power, but you don't, the utility industries are not like made for growth. It takes billions of dollars and years to create more capacity and create more power plants and put them online. So the whole AI hype is really drumming up utility companies. So that's my kind of focus right now in July, is trying to make money from an overpriced stock market. I like my position in Bitcoin, but I'm not going to be adding to it a whole lot more. All right. So now let's talk about Whirlpool. There was a question on WHR, and I looked at that company yesterday because it was on my watch list. I took it off. So Whirlpool is the biggest U.S. appliance company. They make washing machines, refrigerators, all kinds of good stuff like that. And for a while, especially during the COVID years, they were doing quite well. You look at 2021, they had growth. But this is my apprehension on this stock, is that they're not growing. They're having a tough time. And part of it you could say is the compare. But 2022, their sales dropped by 10%. 2023, sales dropped. Their cash flow is terrible. Cash flow, 366. When we look at trailing 12 months, cash flow, negative $49 million. So the cash flow really went down. See this cash flow line here? So that freaks me out, because I'm like, well, my principal way of valuing a company is based on free cash flows, and these guys have really hit the wall. And when will they get back to producing high amounts of free cash flow? I don't know. And my forecast is they're probably in a couple year turnaround, and when they're ready for prime time, I'll consider them. But right now I'm staying away. There's just too much negative on their fundamentals. They're not producing free cash. They're a small cap company now, but they've been around forever, like 100 years. Small caps are not getting any respect. The Dow-like companies, this is more of a Dow-like company, they're not getting any respect in the market. So it's not an investment that I want to make. I know the lure of a 7% dividend is out there, but you got to look at the appreciation or depreciation. The stock was trading at 234. Now it's down to 100. So you can make that 7% dividend, but then see your stock go down 25% in that quarter. So it's not an investment that I want to make. I took them off my watch list. So thanks for the question on Whirlpool. All right. So Tutomi, this is your first question of the session. Good to see you. So what happens if rates go higher? So if rates go higher, bond values drop. If rates go lower, it's opposite. Bond values go up. So if we see rates go up, long-term bond values will crash. And that's what you got to understand. And long-term bonds, man, that's a game that I haven't really played a whole lot. I understand it, but I'd rather think, like, for me, long-term is 5 years, that horizon. I think that we can somewhat accurately predict what's going to happen in the next 5 years. Like right now, we have a slow growing economy in the US. We have an election happening. So you can kind of see some factors that are going to influence the next 5 years. So you can have a kind of a line of sight. Interest rates, I think, are going to go down over the next 5 years. I think we had a really big rise in interest rates very fast. It broke some things. It broke Silicon Valley Bank. And I think that the Fed's going to begin to ease on the interest rate side and get interest rates down. So weigh your decision carefully on long-term bonds, and good luck with that. Please come back and comment. I'd love to hear you come back and say, I've doubled my money. This is how I did it. I'd love to hear that. I'd love to learn from that. I'm interested in your thoughts. So Sam, on ADC. All right, let me take a look at that. Brian Wall, Walmart, big Walmart. I take a look at Walmart every so often. We'll take a look. Nike. So I'm gonna stockholder in Nike. A video will be released. I think it'll be Wednesday. So if you want to watch the full length, my opinion on Nike, I'll give you a quick opinion on Nike today. MO. So that's Altria. All right. That always has a high dividend. And then Shadow Guy. Final comment before a bike ride. SQQQ instead. Oh, okay. Let's take a look at that. All right. Have fun on your bike ride. All right. So we'll go through those stocks real quick, and then I'm going to end the live stream. Thanks, everybody, for tuning in. Really appreciate it. So let's get into it. ADC. Not familiar with that symbol. Agree Realty Corporation is in Maryland. Fully integrated real estate investment trust, primarily focused on retail. Okay, that scares me a little bit. So retail is a tough business. If you look at their stock chart, right, mostly down. Okay, so you got a $6 billion market cap. They pay a nice dividend. With real estate investment trusts, you don't look at like cash flow specifically. You look at funds from operations. And the way real estate investment trusts work is they have to pay out a certain percentage of funds from operations. So take a look at that whenever you look at a REIT. So out of the gate, right, back to, I like to think of the company. Am I buying into them? Do I like that industry? Real estate investment trusts, really belong in the gray zones, which is you want to be careful. These could be good investments, but they're not awesome investments like in the green. And when I look at retail, you're seeing bankruptcies like 99-cent stores went bankrupt. A couple other retailers are having trouble, and a couple of retailers are doing okay. But retail is not like killing it. They're just doing okay. And I would be afraid of investing in a company that's renting to retail. So just out of the gate, I wouldn't be an investor because I don't believe in the space. I don't believe in the company. Their company is growing at a very phenomenal rate. Very impressive. I'd want to get, understand, where's that growth coming from? The growth rate's very impressive. So why the heck is the stock price not flying up? Interesting. All right. So this website doesn't do a great job of showing funds from operations, by the way. So this company, cash is 15 million. Okay, understood. Debt's 2.5 billion. Understood. They own properties. That's why they carry a lot of debt. Cash flow. So they have negative cash flow. Here's the dividends. Okay. Yeah. I'm impressed with the growth rate. Okay. I like the growth rate. Looking at what 11 analysts look at it, and they're saying that it's slightly discounted by 4.9%. They look at primarily earnings per share, which is going to grow over the next 5 years. So this one's interesting. I'd want to get an understanding of how they're growing, why they're growing. Is it maybe they're in other industries other than retail? I'd want to look there. I'm not a big investor in REITs. I own properties that I rent, residential properties, and I own CTRE and MPW, as mentioned earlier. I have plenty of my capital deployed in real estate, so I'm not actively looking for more. But this one, the growth rate on the revenue looks really impressive. I'd do some more homework and see if you're getting some inside information. That's the wrong word to use. Some information that not all investors are considering. and maybe it is a really strong play, and you get rewarded over time because you've been an investor. So good luck with ADC. Walmart, big, massive Walmart. It's still a big, massive market cap company. $563 billion in market cap. They pay a small dividend over the last 5 years. Wow, look at that stock chart. I just got done saying that retail is a scary place. And part of why it's a scary place is the big keep getting bigger and the small keep getting crushed. Walmart's big. Amazon's massive. Target's massive. So I think shoppers just go to the bigger establishments and do their shopping. Groceries, stuff, TVs, you name it. So Walmart strategy has been working. Their stocks really run up. In the last year, up 33%. Wow, that's really good. Their PE ratio is 30, forward 29. Okay. Growth rate. So this is kind of like the Costco model where they just consistently grow. They consistently are showing the market that we really know how to operate this business. I went too far on that. You can just see the steady growth. When you get this type of credibility on this, Wall Street, you get rewarded. And, Walmart's one of the best run companies. They have a great supply chain. Their customers are loyal. They get good value out of the company. When we look at cash flow, they have consistent free cash, very good. But I will not get to the valuation that they have. They're about $15 billion in free cash flow. The best I could do is I'm probably going to get around $300 to $350 billion value for the company. The company's just a company that's easy for most investors to understand. I know Walmart. I shopped at a Walmart, so I'm going to be investing in Walmart. Cool. Go for it. It's not an investment that I want to make. See that a lot of investors, it's a strong buy, but it's discounted just by 1%. Well, that's not a strong buy in my book. A strong buy is this is a really good company. It's growing and it's discounted by 50%. So Walmart is a good steady stock. I think there's a higher likelihood they're going to drop. Okay. See, they've had some pretty good drops, but this is a pretty impressive stock chart. And it is a very recognizable name. It's not an investment for me. I don't want to make a little bit of money over time in stocks. I want it, I want the Uber story where it's worth 2-3 times more over the next, over 2-3 years versus I think Walmart's kind of setting up to have a pretty good pullback. So thanks for the question on Walmart. So Nike is really had its fair share of disappointments this year. Okay. And, the stock price is not the company. The company is not the stock price. Nike's the number one athletic footwear company on the planet. Their brand is top 10 brands recognized around the world. We're going to have the Olympics. You're going to see Nike everywhere. And they have hit a wall when it comes to growth. You look at their growth in the trailing 12 months, 1.89. They closed their first quarter. They just barely grew. And I think they just closed their year. Their year ends 2/29. So you can see this growth has really hit a wall. And it's kind of one of those stories of, they've had a change in management. And I think the press is really after their new management team. So will these guys begin to grow? Will the stock begin to appreciate? I think it will. When we look at Nike and we look at how, the business, do I want to own that business? I put Nike in the green zone of the quadrant because there's the number one athletic footwear / apparel company in the world. Number 2 is way down. They are the biggest brand, biggest supply chain, best run, best designers, best athletes. Their network effect, their network value is massive. Retailers would love to have Nike on their shelves because it's such a positive brand. So I consider them to be this type of company. And I consider that right now, the market is either doesn't understand them. Maybe the management team is screwing up a bit. But I'm getting through a book where one of the big investors believes that a very quality business is really what we got to look for. You need to be careful not to buy a business because of its management team, whether the management team is really good or it's really bad. Example, like Tesla, right? Elon Musk says anything and the stock flies up. Well, that's like a rock star CEO. And if people want to buy into that rock star, so be it. That's not my value-based investing methodology. My methodology is look at the business. You put any CEO, let's say, in charge of Apple as an example. We went from the legendary founder to Tim Cook. The company just kept flying up. It was a really valuable business. So the business itself has to be super valuable. That's why I'm buying big into Nike. I started investing in them when they hit the bad zone in their value recently. I'm down on the stock, down 18% or so. Started buying in this zone, and I want to build up a position up to 50,000, maybe more in Nike, because I believe that's one of the big companies that is going to be worth far more because they have so many advantages against their competitors in their given market. And consumers are willing to pay 2 to 3 times more money for a pair of Nikes versus another brand. That's the brand equity that retail and retail consumers are like, hey, I'd rather walk around in a pair of Nikes. I've raised 2 kids and I was a kid, a long time ago. And I can tell you brands really make a big difference, for everybody. But, who wouldn't want to wear a pair of Nikes? All right. So that's my Nike story. Again, video is going to be released. Look for it this week. All right. So let's look at Altria. So Altria pays a really nice dividend. These guys generate very good cash. It is a business that is, dying off. They should get more into the whole vaping market versus cigarette, market, but they generate good cash. You can see their cash flows are just phenomenal. And when you look at $9 billion of cash, this company is undervalued. It should be worth more. Analysts, 6 of them cover it, and they think it's overpriced by 1.79. I could give you fundamentals that show this company is undervalued significantly. But the biggest headwind against Altria is that cigarettes cause cancer, and a lot of people die of diseases caused by long-term smoking and excessive smoking. And that's always going to be the image of the company. So I think that's the biggest apprehension to Altria. I'm not, I'm an investor in all kinds of different industries and sectors. I'm not an investor in Altria, and I would never be an investor in a cigarette company. That's just my choice that, hey, I don't want to make money in a business where people smoke and they die. So I think a lot of investors feel the same way. And I think that's why maybe the fundamentals are not driving the overall valuation of this company. 1 year return, 40.44%. Over the last 5 years, 4%. So that's Altria. It's always been a lure because of this dividend. And, I can't argue against it. I think their fundamentals are really strong. All right. So that's Altria. And we're going to end with SQQQ. Hopefully I can do something with that. I'm not a big ETF guy. So this is QQQ is the exchange traded fund based on the NASDAQ. The fund provides. So this is pretty much the inverse of the NASDAQ. So you're basically shorting the NASDAQ to some extent. And you can see that over the last 5 years, you would have lost substantially on this investment. You'd have gone from $800 down to $7. You would have lost, geez, what is that? 99% of your investment. Interesting. Now, I don't get into investments like this. A dividend yield of 8.15. Interesting. But maybe I will. I'm going to take a look at this one and see what it's about. And, you know, as kind of like to end the video or the live stream, excuse me. We're in an expensive market. I don't get a lot of argument from people. I think people, when we look at marketplace, the stock market, over a long period of time, you'll see stocks go up in value. That's a rational statement. But along the way, you're going to have pullbacks. You're going to have, kind of periods where the market corrects itself for excessive prices, excessive, greed. And I think we're nearing that point. Having said that, I continue to invest in what I'm seeing, what I think is going to happen a year from now, 2 years from now. If I think that the NASDAQ is overpriced and it will have a correction, I may buy some of this SQQQ. And the reason for it is, I put a lot of time and energy in looking at, the markets, and analyzing my, companies, analyzing industries and so forth. And I have to invest in what I believe is going to be the conclusion. I don't get it right every single time, but I've gotten it right many times. And I've gotten it right on some occasions where I made a lot of money. So I constantly, research, trust my research, and then make investments, and then learn from both gains and losses. So that's where I stand with SQQ. Winter, it's coming. How are you? Thanks for tuning in, man. Very good to see you. Thank you, Brian, for tuning in. Sam, yeah, thanks for your question. Really appreciate you. You're long 5.9. Shift for payments. So Global Payment Network, I'm not big on. I've looked at that company a couple of times. I'm not familiar with Shift 4. I think the payment market is really getting crowded. Even PayPal is getting beat up. And then thoughts on NE, Noble Corporation. I'm going to do a quick one here. Offshore drilling contract. Okay. So these guys are going to drill as oil prices go up. So this might be a good play. As oil prices go up, you're going to see this company become more valuable because oil companies will want to drill. Although drilling is like, if you start drilling today, you're not going to see revenues for 5 years. So it's kind of a long-term play. This company pays a nice dividend, and it looks like it's been the price is being kind of beat down a bit. $6 billion company. Let's see how consistent they are. Oh man, their growth rate is phenomenal. Wow. Yeah, I'm going to look at Noble. My opinion on NE is that it's worth analyzing more. And if I find it to be really interesting, I'll record a video. I have been recently, because as mentioned, I'm a big investor in Chevron, but I've been like, man, I'd like to look at the rest of the kind of like the whole ecosystem of oil. And this might be a good one to look at. So I appreciate the suggestion. All right, guys. So everybody, thanks for tuning in to the live stream. Really appreciate everybody tuning in. Appreciate you watching the videos. Please keep the comments coming. Tell me what's good or bad, and I'll continue to adjust. Also share, tips on stocks that you're seeing, ideas that you're seeing that work for you. Love hearing that as well. And everybody have a nice Sunday. Let's make some money in July. And thanks for tuning in.